name is Eddie Tofpik. I'm Head of Technical Analysis and Senior Markets Analyst at ADM Investor Services International Limited, and here is your weekly technical analysis of the Chicago soybean complex. I'll start with Chicago soybeans themselves. Beans in the teens, almost no more. Last week was a seminal week in many ways. After 2 weeks ago now of consecutive countering actions to the fourth level and knowing something is not right, last week was a large but orderly decline, down through the old 1459 to 1467 gap from May 2014, the flatlining medium moving average currently 1443, the 2021 uptrend currently 1427, which will be kept, and I'll explain why shortly, through the recent 50% Fibonacci line at 1405 and target X at 1353, the target for the May high to date bearish halfway hesitation. Finally, at the end of last week, the market reached target X1 in the 1297 area. And this is where I'll slow down a little and explain why target X1 was important. You may recall over the last few weeks, I have been talking about a large pattern, a bearish bump and run reversal top formed throughout 2021 so far. I said 3 weeks ago, and I quote, "So why am I still talking about this bearish bump and run reversal top?" Well, it very much depends on the recent action. The indecisive spinning tops either side of last weekend, remember this is some while ago now, even if they drove the market higher, and today's action of the market seemingly being reluctant to push up over the 2014 high at 1522. The bearish bump and run reversal top still resonates with me, especially the hesitating way the pullback has moved back up. I would suggest looking closely for one more week and seeing what the market says in the meantime. End of quote. Well, that was 3 weeks ago, and you can now see why that resonated with me. This bump and run reversal top held true, and an estimate of the full move lower would have been down to the 1297 area. This is interesting as it would tie in with the rising long moving average right now, currently right around 1306, as well as the 2021 low formed in January. The long moving average is now higher than when I last spoke, but you can see what a combination of target X1, the long moving average, and the middle time, currently 1312, as well as the lower time, currently also at 1200, of the acutely bearish Andrews pitchfork from May to June move helped corral the market lower to reach its target, and then held up prices, as we've seen this week. Today we're having another go lower, so it is prudent to look below the long moving average for some further support. This would be from the 250% Fibonacci levels of the April 2020 to May 2021 move at 1243 and the 2019 to May 2021 move at 1229. However, there is one other feature to bear in mind, and that is a pullback. You see, a pullback could raise the market up to the 1465 area and still keep the bearish incentive with this market. That is outside of the bearish shift pitchfork over the bearish bump and run reversal top trend line, and one that I asked you to remember. Remember that one I asked you to remember? The 2021 uptrend. And even over the medium moving average as it stands right now. It very much depends on what pattern the market would look to form in the coming days, or perhaps even weeks. I just thought it best to let you know what the topside risks were and where the support was below and what was out there. Chicago soybean meal. The month of May was a monthly key reversal down. It's important to remember that. In June, after the first week, market dipped down and closed below the long moving average, currently at 398.5. Last week's prices dropped and closed below the important 50% Fibonacci line of the August 2020 to January 2021 move. The May to date downtrend, currently at 364.70, has been an excellent indicator of the bearish angle of attack throughout June. The squishing between the declining downtrend and the 50% Fibonacci line was what brought the latest sharp move down last and this week. It's like squeezing an orange till the pips squeak. Then there's target X below in the 337.30 area. I think I'd better reprise my commentary from last week now to explain why we have a target X nowadays just below the market. Anyway, I quote, The next is a little bit unsure and a little bit out there, but I'd rather say it and look a fool now than a bigger fool later, should it happen. It is to regard the whole action from the high in May to date as a possible bear flag, come bearish halfway hesitation type action. Now I'm the first to admit it is far from perfect, but if we look at it, we have a possible pattern here with a possible target X on the downside of 337.30. Like I said, I'd rather look foolish now than later. End of quote. That was then and this is now, and you can see that target X, well, is very mainstream as a possible target now, and very doable, apart from one thing. You see, last week I also drew a new bearish 2021 Andrews pitchfork. Currently the market is just above the lower time. That's currently at 342.5, and the lower time was tested today with a low of 340.5. You see, target X is below the lower time, a little, but enough to make it awkward. By late next week, the lower time should have dipped enough to accommodate target X, but will the market have the patience to wait that long and not start a recovery? It's actually kind of ironic that a bearish supported pattern is foiling the achievement of a target on the downside. Chicago soybean oil. This one had some major surgery upon it last time. The market dropped down through the short medium moving average, currently 61.41, congestion band 57.64 to 59.44, containing within it the August 2011 and September 2012 highs. And at that low, after making two consecutive bearish closing black mirror bozos, the market made last Friday an immediate countering bullish thrusting pattern. It was also simultaneously breached a super significant support consisting of the November 2020 to date uptrend, currently at 56.26, the recent 50% Fibonacci line at 55.43, the rising medium moving average currently 56.15, and finally halted at the February 2013 high at 53.96. As I said last week, and I quote, such action is indicative of some long-term repercussions, which is why, with 2 weeks left of June to go, I should tell you that we are on for a monthly key reversal here this month. If we close on Wednesday the 30th of June, either above 62.39 or below 62.33, then we'd be on. This is quite a narrow band, as you can see, and highlights last month's actions, a monthly indecisive doji cross. End of quote. So far, with now a week or so to go, we are still on for a monthly key reversal, but a pullback rally seen this week is eroding that, and we're not far from making a lesser outside month. Anyway, what's next? Well, unlike the rest of the crush, this is not a bump and reversal top. It does not provide a suitable run-in, and the bump, it's not a bump. It's a horn top. However, I am willing to extend a point in the hope of getting some idea of just what is going on here. So if we were hypothetically to take the November 2020 to date uptrend as the trend line for a supposed bump and run reversal top, then theoretically we could see a move down to the 48.85 area. I'm not comfortable in doing that at all, which is why I've not marked a target X on the daily chart. However, if we should look at the 48.85 area, just in case, you would see a line across the chart, the 50% Fibonacci line, the big 2008-2015 move. Just seems appropriate that a big support level would be there. Yet, and it is a big yet there is a lot in the way before we should get down there. Notably the congestion of the halfway hesitation from March and April between 51.26 and 55.43, and which we already started to probe today, housing within it the February 2013 high at 53.96. Well, that was last week. And also the March 2013 high at 51.26. So what about the size of the pullback? Well, this is the pullback we're seeing now. Well, it would seem reasonable, should a pullback carry on, that a move up to the 64.5 area would still keep the bearish incentive. I know that this is a stretch, but please do not think of it as a target. It is not a target. It's a maximum limit on the upside. I'd rather you be aware of that as a limit rather than keep my voice quiet, and I'll let you know instead. Thank you for listening. This weekly broadcast gives the essential market patterns and consequences. Please be aware of the risk disclaimer posted with this broadcast. Copyright is Tofpik and ADM Investor Services International Limited. And here comes the final bit.